I've known Lynn a long time, and Lynn's great. And Lynn it lives my dream life. I'm getting there, but she lives my dream life. Harlan is probably one of the most eloquent speakers I have heard on the topic of reverse mortgages ever. And that's saying a lot, because some of you may realize, you can probably tell from my skull, I'm not a young guy. So I've been in the mortgage business. I left real estate sales for the security of the mortgage business in 1988, and never looked back. So it's been a long run. When I heard Harlan give this presentation, I think it was about 3 weeks ago now, I instantly reached out to Lynn and said, how do I get him to present to my group? So thank you, Harlan. Take over.
Well, thank you. I appreciate the opportunity. I realize that all I do is talking. Lynn does the hard work. She does the work of actually doing the loans. I used to be a loan officer, and I did over 1,000 of these personally on the reverse mortgage side. But Lynn is the one that really gets things done. But fortunately, I'm able to do a little bit of the talking. So after that introduction, I better do a good job, Dan. Wow. So I was trying to put together an AREAA entertainment center for my wife the other day, and I'm just not good at that stuff. I grew up in a farm and everything, but I never got any of that stuff. And so about halfway through putting the pieces together and looking at the exploded diagrams, I said, honey, I'm just going to hire somebody to do this, because it's just not going to work. We're going to get in a fight. And she said, it shouldn't be that hard. Can't you just do step by step? I said, no, I'm just going to hire somebody. And she looked at me and she said, if you weren't good at talking about reverse mortgages, you'd probably be worthless. And there's a little bit of truth to that. I'm just really only good at one thing, because I spent an incredible amount of time the last 20 years learning about reverse mortgages, hanging around people in the financial planning world, the mortgage world. And I hung around a ton of people way smarter than myself that had done research and asked them a ton of questions. And so because of that, everything I'm bringing you today is kind of a combination of all of the things that I've learned from a whole bunch of people smarter than myself, people that charge $5,000 an hour, and I'm here free. So that will make a difference, but I'll bring you some very valuable information. We have been and I want you to, by the way, to be skeptical, because I was skeptical. 20 years ago, if you would have talked to me, I would have told you that reverse mortgages are bad. Stay away from them. They're the loan of last resort. Just don't mess with them. They rip off the old people, hurt the kids, hurt minorities. I was very unimpressed with reverse mortgages. And then I lived in Wisconsin. I was invited to a seminar about reverse mortgages in Miami in January. If you live in Wisconsin, you go to any seminar in Miami in January. You don't care what it's about because you just want to get out of the 35 below chill factor. So that's what I did. And I learned that I was wrong. And there was a whole bunch of things that I didn't know about reverse mortgages. I was underselling forward mortgage, traditional mortgages that I had always sold. And so, because I didn't really understand how housing wealth fit in with everything else that was factored in. But I did know that people that had houses were so far ahead in wealth to other people that home ownership was incredibly important. But what I didn't understand is how that wealth could be properly used. And very few people do. So while I'm going through this, I want you to be skeptical like I was. But I want you to be a little bit more open-minded than what I was, because I just kind of shut them off and said, no, they're just not a good thing. So what I want to share with you is a very simple diagram that best explains how reverse mortgages work and how mortgages and housing wealth period work. And that's why we try so hard. And at Movement, we have a diversity group led by Montel Williams, which is fantastic. And we are doing a ton of things in communities across the country to make sure that minority groups are treated as good or better than anyone else, because it's simply important to make sure that that is in place, because housing wealth is the major differentiator when it comes to retirement, the major differentiator, because people that don't have a house are way, way below people that have a house. It is one of the single most important building blocks in this country for wealth. So if you think about wealth, everybody has three buckets of wealth who owns a home. Bucket one is our bucket. That's any consumer, any borrower's bucket. That's their ability to make wages, commissions, business earnings, later on pensions and social security checks. But what happens is millions of dollars usually is earned from the time you're 15, 16 years old until you're in your 60s. And all of that money goes up top here to this top rectangle from 18 to 62 years old. And it's a pre-retirement wallet. And most of it evaporates right off the top. And you spend it on food, clothes, kids, cars, something called the cost of living. I saw a sign outside a church a long time ago and it said the cost of living is high, but it's still extremely popular. So we have to pay money to be alive. That's just the way it is. And so we spend a lot of money and it just goes. But we try to save money because we know that we might need it for the future. We've all heard the story from when we were little kids of the grasshopper and the ant. And grasshoppers and the ant was good at storing things away for the winter. So we want to store things away for retirement. But the average savings rate is really dismal in this country. It's less than 5%. Less than 5% of of the millions of dollars that people make during their lifetime goes into bucket two. But here's why there's so much wealth in housing. 29% of the average person income goes to housing. If you own a home, 29% of your income goes into the bucket three, the home equity bucket. 29%. That's way higher than 5%. It's 6 times higher. So most people are saving way more money in housing. And you say, well, that's not just savings, Harlan. That's also you're putting a roof over your head. Yes, I understand that. But your house is an investment. Rent is not an investment. And so that is a huge difference and why there's such a big difference in wealth, because everybody has to pay for a roof over their head. But if you get a house, you're paying for a roof over your head, plus you're paying for a retirement account. Are kids taught that in high school? Are kids taught that if you buy a house, you get a free retirement plan with that? No, they're not. They don't understand that if you buy a house, it's not just a roof. You are also buying a retirement plan that can go into the second and third generation. It is shocking that we are not taught something that simple and that basic. Why not? Why don't we teach kids that if you can buy a house, buy one as quickly as possible and teach people how to buy a house, teach people how to have the proper credit and so on and so forth, so they can have a better retirement and a better legacy to their children and their grandchildren. So 29% goes there. Now let's fast forward, and I'm going to stop for in a little bit for some questions, but let's say that now that we get down to the 62 plus bracket. Well, what do people do when they're 62? They don't even take advantage of the retirement plan that they set up. They don't even think about it. Because what they do is they say, okay, I'm going to take some money out of bucket one. I'm going to take my Social Security out of there. And then they say, I'm going to go to my financial advisor and I'm going to ask him about that 401k and ask him how much money I can get. 50% of people have less than $164,000 in their retirement savings. 50% have less than $164,000. Only 10% have more than $1 million. Shocking numbers. And guess what? The people that have money in the top 50% are going to be paying people in the lower 20% of the lower 50%. So that means the taxes will go up. So that kind of puts us all into a problem because there's a retirement crisis. So what's the solution? Well, there's a number of different solutions, but we're a big part of the solution because there's $12 trillion that's been saved in bucket three. 12 trillion with a T. That's the equivalent of all the known gold in the world. $12 trillion in one bucket. And most people don't use it. They go to bucket two and try to get money out of their 401k. They go to get money out of their Social Security in bucket one, but they don't even touch bucket three. Because why? They want to pass it on to their kids, especially minority homeowners who are first generation. In my situation, because I was lucky and I was born into a situation where I was a third generation homeowner, a lot of people are only in the first generation of homeownership, and so they treasure that much more. As I mentioned in the beginning of the talk, I grew up with a lot of Hmong folks in central Wisconsin, and helped them get their first home because a lot of times they had been renting, and so they were very careful about hanging on to that home because they wanted to give it to their children, because their children, they wanted them to have a better start than what they got. And so the issue is if we employ bucket three in the planning in the beginning and we pull money out of bucket three in order to help the next generation, we can help them right now because of all the money that's put into bucket three. Very few people go to bucket three for anything in retirement. They don't touch that. That's designed for the kids. Well, just a second, when you die, you have 3 kids or 4 or 5 or 2 or whatever. Well, how do we divide up a house? Are all the kids going to move in to the house? Usually not. So usually the house is sold and the money is divided up, and then each of the kids get X number of dollars. So they look at reverse mortgages as an enemy because, well, that's going to take away my kid's inheritance. Well, just a minute. If we take money out of bucket 3 and we gift it to our children tax free, what about our kids getting a house right now? We can accelerate that whole situation with minority homeownership, as well as, doesn't matter who it is, we can accelerate homeownership. We just had a lady in Redmond, Washington, where Microsoft is, pulled $400,000 in a reverse mortgage out of her house. 2 kids, gave them each $200,000 and said, go buy a house. Both kids bought a house when she's in her 60s and the kids are in their 30s, rather than waiting until she's 90 and the kids are 60. Now the kids are building wealth in bucket 3. Very simple scenario, but if we can do that, we can accelerate home ownership amongst everybody, but certainly amongst minorities. It just simply makes a whole lot more sense to get kids into a house. Now, if you take a look at this, everybody's concerned about the interest rates right now. Well, I bought my first house right here, 1981, 18%, 19% at the banks. And I got a real deal. I got a contract for deed from a private party for 16.5%. It was a bargain. And then we got to refinance at 12.5%, and we went out for steak and lobster. I mean, that's expensive in Wisconsin. We don't have any ocean close, but it was
my first mortgage. My first mortgage was 12.5%, 5-year arm, direct from the developer, because it was the worst condo in the building. He couldn't sell it. He cut a deal with me. I hugged him when he told me he'd only charge me 12.5%. I hugged him.
Now think about a millennial being talking about a 6% rate. They get all upset about 6.5 or 7, and we were thankful for a 12. Isn't that something? It's perspective. So my second son was born in 1990 when rates hit below 10%, 9.9%. In fact, the front page, USA Today, in the hospital gift shop, so rates dropped to 9.9%, sparking a refi boom. And that was incredible. 9.9, it was into the single digits over here in the 90s. And so this continued. We refinanced at 7.99. And I told my wife, we're all done refinancing. Rates will never drop below 7.99. Well, that was not too smart, because they went down to 7 and 6 and 5 and 4 and 3 and 2. And of course, we're over here. And now they went back up to 6.5, and everybody's real upset about it. But the fact is, when is a good time to buy a house? Anytime. I was getting my hair cut the other day, and the lady, I asked the lady, she said she just moved to the area, and I said, oh, did you buy a house? And she said, oh, no, I'm not going to buy a house. It's too expensive. I mean, don't you realize how expensive houses are, and rates have doubled? And I mean, it's just crazy. And I just jerked, and she almost cut off my ear. And I said, no, you have to buy a house now. You should buy a house now. And she said, why? It's so expensive. I said, you're paying somebody's mortgage. You're either paying your landlord's mortgage or you're paying yours. Why don't you just pay yours? And it doesn't matter what the rates are. Any time is a good time to buy a house, because if I went to bought that house in 1981, I wouldn't have been able to do the move up house in 92. I wouldn't have been able to do a reverse mortgage on my house last year in 2022, because of the wealth that I had built up. And that little $60,000 house back in 1981 turned into a house that's almost worth $1 million today in 2022. As that went through the process in the move up houses. That was an incredible way to build health. Did I put $1 million into the house? No, I didn't. That was a lot of equity that I gained over the last 40 some years. So it is so important to invest as soon as possible, because the more money that we have in bucket 3 gives us more money available to use when we get older. And unfortunately, most people don't understand that. When my son just bought his house a couple of years ago, he was driving home and he said, hey, Dad, Bridget and I just signed our papers and we're all excited. We're the newest homeowner in Eden Prairie, Minnesota here. And we're excited. And we want you to know, Bridget and I read your book. I wrote a book called The Cinderella, the Baby Boomer Retirement. And I said, yeah, you won't be using it for a while. And he said, yeah, but we know that we just started on our reverse mortgage. And I said, well, Josh, you can't get a reverse mortgage for another 31 years until you're 62. And he said, I know, but we know that we're going to get a refund of all of the payments that we're putting into our house when we turn 62. Now, how many kids are going to say that when they buy a house? only kids that have been brainwashed by their father for years. And so the issue is that very few people know that they can get a refund of their payments, and it's going to help them out with retirement. It's going to help them pass on generational wealth. It is going to be a dramatic difference. Now, that's the concept. We'll go into some specifics, but I want to stop here. Any questions that any of you have on the thought process, the idea of what we're talking about, that we can put money into a house, we can take it out. We put money into a 401k, we take it out. We put money into Social Security, we take it out. Why can't we do the same thing with our housing wealth? Any questions, comments? So everybody's going to do a reverse mortgage when they turn 62?
Can't wait.
I would love to do it now, but I'm only 52.
Well, are you married, Dick?
The kids are on the call.
I'm sorry?
Are you married, Dick?
I am, yes.
Oh, okay, that's good. If you weren't married, I'd tell you to marry an older lady, and then you could get in early. You wouldn't have to wait 10 years.
How long does she have to be entitled for?
No, you're married. We're not going to discuss that any further.
No, but that's a good. I think that's a. If I'm a 52-year-old guy, which I am, and if I happen to marry a 62-and-a-half-year-old woman, how long does she have to be entitled before I'm qualified for a reverse mortgage?
Just one day.
Instantly, yeah.
Okay.
But she needs to stay on title with you. You've got to stay married in order to stay on the reverse mortgage.
That's a bad.
Just a formality, right, Dan? I mean,
I did a lot of VA shotgun mortgages back in the day, because needed to have the spouse on the loan. So
there we go.
all my VA shotguns. I had my buddy who was a justice of the peace. They'd marry him on Friday. We could close the following Monday.
And in my income, does reverse mortgage still require tax returns and verification of income, or is it purely based on the collateral of the home?
No, that is one of the things that a lot of people ask me, why are reverse mortgages bad? Where there's smoke, there's fire. I mean, if somebody says they're bad, there must be a reason why they say they're bad. And there's several reasons. There's basically three reasons why people think reverse mortgages are bad. But one of them is exactly what you just said, Dick. It used to be that this was a collateral-based loan, and the only thing we cared about is somebody was over 62 and they had a house. What's the value of your house? Are you over 62? And that was it. There was no other qualification. We didn't care about your income. We didn't care about your assets. We cared about nothing, which was a mistake that FHA did it that way, because you have to pay your taxes and your homeowner's insurance, and you still have to eat. And so if you're don't have enough money coming in to pay your taxes, your real estate taxes, well, guess what? You're going to get foreclosed on. And the very thing that we think we're helping with is going to hurt you. And you're going to end up losing your home because you can't pay your real estate taxes. Thousands of people lost their homes that got into a reverse mortgage, and they couldn't pay their real estate taxes. And so we looked awful. We were foreclosing on old people. And it's okay to foreclose on young people, but foreclose on somebody like me with gray hair, I mean, then everybody gets upset about it because we're a protected class. So the issue is that we were foreclosing on a whole bunch of old people, and it looked really bad. It was front page news on ABC News with Diane Sawyer, front page on Wall Street Journal, USA Today, reverse mortgages kicking old people out of the houses. So we became very unpopular very quickly. So we changed the rules, and we said, no, we're going to do some financial assessment. We called it FA, financial assessment. And we're going to make sure that not only are you old enough, not only do you have value in your house, but you are able to pay your taxes, your insurance, your HOA, and all of the costs that are involved with it. And that has dramatically changed and taken we once hit 10% in foreclosures on our reverse mortgage book. We are now down below 1%, because now we're only giving reverse mortgages to people that can afford to stay in their house. If you can't afford to stay in your house, all we're going to do is prolong the inevitable. And that's not a good idea.
Harlan, of the 1% that are in foreclosure, how many of those are simply that the person passed away, the borrower passed away, and there's no heir to take the property?
Thank you for clarifying that. The vast majority are foreclosures after somebody dies to clear the title so that we can sell the house. That's it's very rare that there is a foreclosure on somebody that's living in the house. That's a very important clarification point. So thank you for bringing that up, Dick, because we look at, did they pay their taxes the last 2 years? Do they have the ability to pay their taxes? Do they have the willingness to pay their real estate taxes? If they haven't paid for the last 2 years, there's probably a problem, or else we got to find out why they didn't pay it. And so we look at their income. We don't look at debt to income ratio. We look at residual income. We don't look at credit score. We just look at, have they paid their taxes? Have they paid their mortgage? If they could afford to pay their mortgage along in that situation. So great question for sure.
Would that income be a household income or the individual income? So for example, if it, because I'm not 62 and I marry a 62-and-a-half-year-old woman, if my income is significantly higher than the 62-and-a-half-year-old woman, would my income take into place because I am a spouse?
Yes, that wouldn't automatically. We would first try to qualify based on her income, but you would be considered a compensating factor, and a pretty good compensating factor if you were the one that was making the money. So we do look at the whole picture, but we first try to qualify just the person who is over 62. And most of the time it can be qualified with Social Security.
Okay, and a follow-up question to that is, let's say the old lady passes away. I shouldn't use the word. Stan's laughing at me. Tina knows me, so I'm a big clown. But it's,
Dan, I don't know if I should have brought this up to Dick. I really.
We gotta make this. You gotta make mortgages fun again, right?
Dick is married to a beautiful woman, and she's a super hard worker. And half of Dick's success in life is due to his wife, maybe more.
Definitely more.
He's not looking for any 62-year-old woman to marry.
I'm just giving a scenario here. Just you never know what will come around the corner, right? But let's just say the old lady passes away, right? And do I? And if I'm not 62 yet, do I then have to refinance the house, or do I just? How does that all work?
Well, Dick, you're almost a plant here, because that brings up my next point. Why don't people like reverse mortgages? Because we kicked widows and widowers out of the houses after their spouse died. So we got a very bad name about that too, because what happened is older men, usually, sometimes older women, would marry somebody younger. We call it an underage spouse. Anybody under 62 is underage in our book. My wife is underage. She's 59. So anybody that's underage could not qualify for the mortgage. So so often men would not wait for their wives to get older, or women wait for their husbands to get older, and they would just do the mortgage, and they'd take their spouse off from title. And that was horrible, because when that person died, the spouse got kicked out. New rules now. So when you're married to this old lady and she dies, within a day of signing the mortgage, you can stay in the house until you're 150 years old, Dick, without making a payment.
And then I can move into Lynn's boat with her.
That would be part of the deal. Yes, you could just live in the house part-time and then move into the boat and cruise around the Bahamas. So
nice. Sounds like a good plan.
Ideas.
I have a question on
Yes.
the equity of the house, and you mentioned it a little while ago about Dick actually living there until he is 105 years old. Some folks tell us that the reason why they don't like reverse mortgage is the fact that once the equity is gone, they're kicked out of the house. And the next question is, if the individual dies and there's equity in the house, will it be actually given to the heirs?
Yeah, so you just hit upon the two most important misconceptions in the reverse mortgage world. We never take ownership of the house with an FHA HACM home equity conversion mortgage, which is the most common 95% of the reverses. We're lenders, we're not landlords. Neither Lynn nor I work for a company that wants to own your house. We have no interest in owning your house. We just lend you money and collect interest. That's our business model. It's pretty simple. So when we lend you money and collect interest, we don't collect it on a reverse mortgage until the end, until both people have passed away, regardless of what the equity position is. Most of the time, in the answer to your second question, most of the time there's equity left. Most of the time, the loan balance is lower than the value of the house, almost always. But and then that goes to the children, to whoever the heirs are, 100% of it. So if I have $1 million house and I've used $200,000, the other $800,000 goes to my children, not to the bank. And that is so important. Now, everybody says, oh, the reverse mortgage, that's where the bank takes the house. They just kind of say that like they were taught that in kindergarten. And it's not true, but everybody says it, so people start believing it. Oh, the bank takes the house. No, the bank doesn't want the house. We have no interest in the house. We want the interest on the money that we loan. That's our business. And so if there's equity left, which there usually is, that goes to the children. However, think about a casino. Would you go into a casino that said you are guaranteed never to lose? You're not guaranteed to win, but you're guaranteed never to lose. Now, I'm not a gambler, but I'd go into that casino because I'm guaranteed not to lose. That's a reverse mortgage. You are guaranteed not to lose. You are not guaranteed to win because we don't know the value of your house next year, say nothing about 20 years into the future. So because of that, if you go upside down, which is now an answer to your first question, which my uncle did because he died at 94 in 2009. He was upside down already in 2008, but he didn't get kicked out of his house. He died in his house upside down on the house. All of his equity was gone because his house went from $200,000 down to $100,000, and he owed almost $150,000 on the house. He didn't get kicked out. He could have lived in his house if he would have been alive for another 5, 10, 15, 10, 20 years until he was 150. That's the time when you get kicked out of your house is 150. Fortunately, we haven't had to do that yet. So the issue is that no matter what happens to the equity, if the equity is gone, the equity is gone. If you spend all the money in your savings account, does the bank kick you out of the bank? No, you just don't have any money left. So but you can still go into the bank if you want. You can still deposit more money, or you can still take your checking account or whatever. So the issue is that you never get kicked out of your house unless you don't pay your real estate taxes. And you'll get kicked out of your house if you don't have a reverse mortgage and you don't pay your real estate taxes.
Pretty quick.
So very quick.
Mortgage.
Exactly. Faster than a mortgage. It takes longer for us to foreclose than it does for the county in most cases. So here's the issue. If it's good, think about the casino. If it's good, the money goes to your children. If there's equity left, all of the money goes to the children. If it's bad and there's nothing left, the bill goes to Federal Housing Administration. And you don't pay it, your kids don't pay it, your state doesn't pay it. It guarantees to protect the kids. I wouldn't be in this business if that factor was not in place. If these loans were not FHA insured and if they were not non-recourse, Lynn and I would not be selling them because it's too big of a risk, because we don't know how long you're going to live. That's taking way too big of a chance. And yes, then you could get kicked out. So where did all this stuff come from? It came from mortgages before 1988. Reverse mortgages came into existence in 1988 under Reagan's term. Before that, they were shared equity loans. And that means that the investor did own your house and you were given money and allowed to live there in a life estate until you died, and then you were kicked out. And sometimes you were kicked out early if there was a term. There were some reverse mortgages that were only a 10-year term. And if you didn't die in 10 years, you had to move. Those were horrible. And they're still around. Open Door, and there's some other ones like that. And I wouldn't recommend them to anyone. There's some rare cases where it might make sense in a terminal illness or something like that, but it very rarely makes sense to be involved in that. But realize that we will give you somewhere between 40 to 60% of the value of your house. We're not buying your house. You still own the other equity. So if we give you $400,000 on $1 million house, you still own $600,000 worth of equity. If we give you $100,000 out of a $200,000 house, you still own the whole $200,000 house. It's just that you owe $100,000. How can you get the money out? 3 ways. You can get it out in a lump sum. Maybe you want a lump sum to help your kids or your grandkids buy a house. Or you want the money out to buy a car or to fix the roof or whatever. So we can give you lump sum money. We can also give you a monthly check. Just worked with a client this morning. They get $750,000. They have a $750,000 house. We'll give them, they're in their early 60s, 61 and 69. They will get money, $1,400 a month for the rest of their life, no matter how long they live, and regardless of what happens to the value of the house. So we can give you a monthly check. Or we can give you a line of credit because you don't know how much you'll need. You don't have any need for money right now. So we just give you a line of credit. And you say, well, I can get one of those at the bank. It's no big deal. No, not these kind you can't. Because we have 3 very unique things. Number 1, you don't have to make a payment ever until the end. Number 2, it can never be called. If the value of your house goes down, the market crashes, stock market crashes, everything gets bad, COVID hits, your line of credit is never shut down. That's very important because regular lines of credit, billions of dollars of lines of credit were canceled in 2020 and were canceled in 2009. Our lines of credit are never canceled. That is critically important. And thirdly, it grows. If you don't use your line of credit, next year it's worth 6% more. And the year after that it's worth another 6% and so on. So if you have a $200,000 line of credit, next year it's worth 212. The year after that, 224 and so on. It keeps going up and becomes more valuable. And you can use that to help your kids, your grandkids, yourself, whatever the situation is, to make sure that your family is better off and that you're better off during retirement and your other money grows. A lot of people are pulling money out of their house right now because they don't want to pull money out of their investments because their investments just went down by 20%. Why not use the money inside your house? It's tax-free. You can pull it out and let your investments recover. So, long answer to a short question, Christina. I'm kind of good at that and rambling on, but I think that answered your question.
Yeah, perfect. Thank you.
Okay. Craig, go ahead. You had a question?
Yes. Is there like counseling that the homeowners would have to take before taking out a reverse mortgage?
There is. It's required. You have to take a 1-hour counseling session that is done by an independent person that is not employed by Movement. That is certified by FHA. However, if one of your clients or you would talk with Lynn, you don't need counseling. I mean, you still got to pay for counseling and you still got to do it, but it'll be, just a formality because Lynn will do such a good job of counseling all the way through and asking a whole bunch of questions about how long you're going to live there, what's going on with your kids and your grandkids, what money do you want to spend, how long do you want it to last, et cetera, et cetera, et cetera. And she will do such a good job that the counseling will be purely a formality. And it will be unnecessary, but it still has to be done, and you have to pay $125 for an hour of counseling. But the job that we do at Movement is so complete that most people say, "Why did I have to do that? I didn't learn a thing," because Lynn already taught them everything. So very important scenario. We go very thorough. In fact, what we even do is ask them can we do a Zoom call with your kids, because we want your kids to know what's going on. And then we can counsel the kids as to what's going on and how they're going to handle things and how they're going to work together with mom and dad to preserve wealth. Because preserving family, earning money is relatively easy. Saving money is hard. Passing on wealth is incredibly difficult. And that is generational wealth is one of the toughest things. Things are still going on from the Rockefeller fortune. The Vanderbilt fortune, that was gone in 3 generations. So 2 families, and it's an incredible story. And a great book written called What Would the Rockefellers Do? That kind of explains some of those things of what the difference is.
So, Harlan, I know you obviously got a ton of information. I know most of the people are on this call to learn one specific product, and that's how you can use reverse mortgages to purchase real estate. Because everyone I tell says, no, you can't do that. So.
Exactly correct. So here's the situation on, and by the way, I want to answer Christina's question. Is there a limit to the loan to value in reverse mortgage? Yes, the limit is 75% when you get to the year 90s. 40%, you get 40% when you're in your 60s, 50% in your 70s, 60% in your 80s, rough numbers. That changes every Tuesday based on the interest rate. And then we tell you the numbers of what those are.
So Dick should be looking for an 80-year-old woman, not a 62-year-old woman.
That could happen
Sorry,
too.
go ahead. I'm sorry.
Yes, we can't be putting more ideas in Dick's head.
Yeah, well, on that same topic, right? I'm all about ideas and helping out people, including myself. Is there such thing as a reverse jumbo? So, for example, I have a let's say I have a $3.5 million house with a current mortgage of $300,000, and I have I find an 80-year-old spouse. I'm up to 75% LTV.
No.
Sounds like Dick's talking about his own property here in Boston. Go ahead.
No, what happens is there's a cost for having an underage spouse. We go according to the age of the youngest borrower. So you will get less money even if your spouse is 90 and you're 50. We're going to go according to your age, not hers, because we're guaranteeing you to stay in the house, not her.
So at 52 years of age, I'm maxed at 40%.
That is correct.
So
Maybe a little bit less depending upon what the mortgage is at the time. So
but is there a jumbo limit for loan size?
There is. 4 million is the limit.
Okay.
So we go up to $8 million houses with $4 million limits. And so we have, that's a smaller part of the market, but it is a growing part of the market. And so we have 3 different jumbo products, and they are based on house values up to 8 million. Great question.
Thank you. My mind's always
So,
thinking.
yes, you want to do that. That's good. He was, by the way, the best website to check that out, Dick, is ourtime.com. That's our senior dating site. But no, don't go on there. Okay.
I thought it was Tinder for 50s.
I don't think that exists yet. I'm sorry.
That's another business opportunity as an entrepreneur.
All right.
Okay. So there's a ton of people, and there's a whole bunch of people my age that are in the wrong house. A whole bunch of people that are in the wrong house. And we should move. I was in the wrong house. I was in a 2-story house where we raised our sons, 4 sons, and it was a big house, 6 bedrooms, 4 bathrooms, 5,000 square feet. We didn't need that anymore. Didn't make sense. And with stairs, and it wasn't a place to age in place. There's a whole bunch of us in this group. That's the biggest group right there. There'll be 73 million of us by 2030. 73 million. That's going to be the biggest chunk. Baby boomers are a huge amount. Demographics runs everything in the economics from there. And most of us, more than half of us, want to move. Why do we want to move? Because the number one reason to move is we want to be closer to our family and we want to reduce home expenses. That's our main 2 goals. Yeah, there might be a change in health status. We might want weather issues or some of the other things, but the main thing is we want to be close to our kids and our grandkids. We don't care if it's warm there. We don't care. We just want to be close to our kids. And that's exactly what we did. We moved to a more expensive area. So let's say, for example, that I've got a $300,000 house that's all paid off and I sell that house and I want to move to a more expensive area, or I want to move into a brand new home in a 55 plus community, or I want just a house with no repairs and maintenance and I'm going to move to a more expensive area because it's going to be by my kids. And generally kids are where jobs are. And so it's kind of expensive. So I'm going to be competing with first-time home buyers and millennials. That is that other big group that was on the left side of the screen. Well, when I want to move, I can take $300,000. And if I'm eligible for about 40%, that means that if I put down 60%, I can get a 40% loan. And I'm instantly into a $500,000 home that I just upsized into because it was more expensive in that area. And because I wanted a newer house with no maintenance and I didn't want repairs and so on and so forth going into retirement, I just got a $500,000 house for $300,000 down and I have no payment. The only other way to have a 0 payment is to pay cash. I'd have to come up with 500 grand. I'd have to pull money out of bucket too, or not buy at all because I just got to stay where I'm at. There is a huge number of people in our age bracket that will not move because we have our house paid off or because we have a 2.75% mortgage. And we know that it's going to cost 6% to move. We know that it's going to be more expensive to move. So we just kind of stay where we're at. And that's a mistake. People, when you are moving, and you can take 300,000 and turn it into 500. When you can take 500 and turn it into 800, it changes generational wealth. I was just talking to a client that's moving from Florida to be by his kids who are now all settled in Oregon. And he's going to sell his house in Florida for 500 grand. He was looking for a $500,000 house in Corvallis, Oregon, which is a university town. Couldn't find it. And so I explained to him that if you take your 500, you can buy up to an $800,000 house or an $850 house because you're in your 70s. Well, he said, we were having a problem with these $500,000 houses because a lot of them were fixer-uppers and they were, entry-level houses. I said, if you go to an $850,000 or a $900,000 home, he said, well, yeah, but then I have a debt and I got to pass it on a debt to my kids. And I said, you're also passing on a $900,000 house or an $800,000 house, which is going to be worth more almost for sure than that $400,000 or $500,000 house that you're trying to buy. It's a very simple process. When you're buying a house for a reverse for purchase, you're just putting down 50, 60%, depending upon your age. We're coming in with the other 40 and 50%, and you're done making a mortgage payment. Does the balance go up? Sure. But so does the value of your house. And house prices usually go up by 4% a year, have for the last 100 years. And interest rates are only about 6%. So you'll never catch up. There'll always be more equity available for your children down the road from a legacy standpoint. It's really kind of foolish not to buy a house with a reverse mortgage because there is a huge amount of advantage and tax benefits by occasionally paying interest and pulling the money back out as you need it. tax-free, and you have a huge deduction as you bunch those deductions together. So does it make sense whether you're upsizing or downsizing or staying where you're at? It makes sense for the reverse mortgage because there's all kinds of people that feel that they do not have the money when in reality they do. They want a different home, but they don't realize that they have enough assets to be able to do that. So it is a huge opportunity for people our age to move when we think we can't and we think we're stuck. And we're not stuck. We're in a situation where we can sell our old house and buy a more expensive house, which is exactly what I did when we sold our big old house in central Wisconsin. That still wasn't worth as much as a newer house in the Minneapolis area, because in the Minneapolis suburbs, it's more expensive than central Wisconsin, in a county that we have more cows than people. It's very rural. So it just makes sense. And yet we want to be by our kids. So I get to go out and see our two cute little granddaughters tonight, because it's only 10 minutes away. If I was 3 hours away, couldn't go see them. And by the way, our kids really like it because we're free babysitters. If we're talking about family, the closer we live, the more fun it is and the better that it is. And unfortunately, a lot of families are separated because they think that money is holding them back when it's not. So,
sorry to interrupt.
Go ahead.
One last question, and I do have to run off to my 12 o'clock meeting. What is the turn time for a purchase on a reverse?
well, I'm glad you asked that because we're really incredibly cool on that. And Lynn is already smiling. There is no company in the industry that is as fast as we are. We can do it as quickly as 17 days from the offer to purchase accepted, the purchase acceptance. So does everybody need 17 days? No, sometimes 30 is fine, but we are very fast at purchases. Some companies will take 60 to 90 days on a purchase. That just doesn't make sense. We don't believe in that around here.
Yeah. And then one last question is, what is the current rate? I know it's adjustable typically for HECMs. What is the current rate, and are there points associated with this?
Yeah, so I was talking to a group of financial advisors yesterday, and I was about 35 minutes into the talk, and they said, "This is like incredible. We had no idea. There just isn't any downside. I can't find a downside." And I said, "There is a downside." And she said, "Well," the financial advisor lady said, "I was kind of thinking, I mean, this is like too good to be true. This isn't anything that I thought they were." And I said, "It's not too good to be true. It's too good to be free." And that's very important to understand. There is a 2% fee on the value of the house. If you're buying a $500,000 house, there is a $10,000 fee that comes out of equity normally that is charged to the borrower as mortgage insurance that goes to FHA, not to Lynn or I, not to our company, but $10,000 goes into the mortgage insurance fund to take care of any people that live too long or values of houses that go down. And so that is much more expensive than a regular mortgage, but it's way cheaper because you never have to make a mortgage payment. So if you do the numbers,
you said that's 2% of the purchase price, not the loan amount. 2% of the purchase price. So if it's $1 million home, it's $20,000.
That is exactly correct.
Got it.
And so,
okay. And can that be paid by the seller?
On a purchase, it could be.
On a purchase, yeah.
It actually cannot be. The seller cannot make any contributions. Neither the seller nor the lender can make any contributions on a reverse mortgage. Is that a stupid rule? Yeah, it's an FHA stupid rule on reverse mortgages. Doesn't make sense, but that's the way it is. But the seller can drop the purchase price. So in a way they can pay for it, but they cannot pay any of our closing costs when we're buying a house. However, let's remember this. If I've got equity in my house, I'm only giving up 2% of equity. So it's really insignificant. If I'm buying a house, yes, I'm putting an extra 2% in. Is that expensive? Well, compared to what? Because if you really take a look at it, the most expensive way to buy a house is with 20% down, because you're going to be paying for the next 30 years. So that's a very significant issue. So if we really look at what the most expensive way is to buy a house, well, the most expensive way is to pay on a mortgage for 30 years or to pay cash. If I'm buying a house with a reverse mortgage, what's really cool is I only have to pay 60% down, 50% down, and I'm done. I never have to worry about paying again. So that's a significant difference.
And what is going rate? Because I do have to go. I'm sorry.
Oh, 6.5% is about the going rate.
And that's an ARM.
Yes, we're 2.5 points above CMT,
CMT, okay,
to be
great.
technical about it.
Appreciate it. Okay, thank you so much for this. I do have to find, thank you, Dan, thanks for putting this together. I'll
Thank you.
see everybody eventually, some of
Tomorrow.
you guys in DC, some of you guys maybe not.
I think pretty much
And
a lot of us
thank
on
you
the
so much.
call today tomorrow. Yeah, excellent.
Okay, awesome.
Thank you, Dick.
Lynn,
Great to
Lynn
meet
and
you. I
Harlan,
love your
thank you
sense
so
of
much for
humor.
your time. Take care.
Appreciate it.
So the issue is when you talk about
It's 12 o'clock is with the 80-year-old woman down the street. Go ahead.
I'm glad Dick was on. He certainly gave us a good
Very colorful.
laugh. Yes,
Very
he is.
colorful.
So when we talk about costs, in fact, there's a whole chapter in my book that dedicated to that. It's called because it's a Cinderella book. It's called the Cost of the Glass Slipper. The issue is that there's nothing that's expensive if you get more value than what you put in. And so, for example, are cars expensive? Yeah, I heard that there's only 2 models of cars that you can buy new for under $20,000. That's crazy. A lot of cars. The average car payment I read this morning is $729 a month. I remember when $300 seemed like an expensive car payment. So, are cars expensive? Crazy expensive. How many of us don't want a car? I mean, we could get by with a bicycle, or a horse, but chances are we really would rather have a car. So, are they expensive? Yes, but compared to what? Ubering, riding a bicycle, what they are having no car at all. So, the fact of a reverse mortgage is your single biggest expense in retirement for the vast majority of people is housing. Everybody says your biggest expense in retirement is healthcare. No, if you want to manage a fantastic retirement, you have to control your housing costs. Now, if you're renting, you can't control your housing costs. That's awful. You go into assisted living, you got to pay every month. You can't control your housing costs. It's huge. But if you have a reverse mortgage, your only housing cost is your taxes and your insurance. So if we can pay that little bit more money up front for that guarantee from FHA, and we pay that extra expense, it's cheaper for the rest of the time. It's a far better deal than paying every month for the next 30 years or paying every month for the next 15 years or whatever. So if we can control housing costs, we have now mastered being able to have the best retirement that we can have. Is there an upfront cost for that? Sure there is. If there wasn't an upfront cost, you should be suspicious, because things that are too cheap, there's usually an issue with that. And the upfront cost goes to the Federal Housing Administration to guarantee that no matter what happens, my wife will never get kicked out of the house, my kids will never have a bill, and I will never have a bill, because I get this statement every month, which is really cool. It says, it's got my biggest obligation, and it says this is not a bill. I just want to make sure, and I really appreciate the time that we spent together, because I'm just a farm kid from Wisconsin who never went to college that figured this out. If I can figure this out, a whole bunch of people can figure this out. It's not that complicated. And there are thousands of people. I just saw in that same article this morning, 70% of people are planning to do a HELOC this year, over 62. Only 7% are planning on doing a reverse mortgage. Oh my goodness. So they're going to borrow $100,000 so they can pay back $150. On a monthly basis in the most uncertain time of their lives. We've got to get this news out so that we can properly use housing wealth, not only for Asian Americans, but for anybody to understand that we can properly use the housing wealth that we've been blessed with, that we've been able to put together, and that we can share it with our kids and our grandkids so that they can gain the wealth. That it's not just okay for us to be rich in housing wealth. We want to get our kids and our grandkids to be rich in housing wealth, and we want to teach them. In fact, I bought a house for my 5-year-old granddaughter last year to be an example to her of what she should be doing with her money. No, it was a Barbie dream house and only cost $199, but I still wanted to get her on the idea of home ownership. So, any questions that we can finish up for us in the last few minutes here?
I have one more question.
Yes, sir, Craig.
Is there any downside to taking out a reverse mortgage?
The only downside is not understanding the upfront costs. You should never take out a reverse mortgage if you're going to be knowing that you're moving in the next couple of years. The rule of thumb is 3 years. If you're not in the house for 3 years, you should not take out a reverse mortgage. And the other downside is not understanding it and not having your kids understand it. The next generation should understand what you're doing and why you're doing it, because otherwise they're going to be shocked and pissed off at the end, and they're going to complain and tell all their friends that reverse mortgages are awful because they never knew you took out a reverse mortgage. And so kids should understand, how does this fit in with your retirement plan? Those are the two major downsides that happen, is the family not knowing what's going on and people getting a reverse mortgage when they're not going to stay.
Harlan, you mentioned in our last call that you were that I witnessed was that you explained to your kids that you had the choice of sharing the money with them now, or them taking it when you're gone. Would they rather go on vacation with you now, or or bring your ashes to a beach someplace? Whatever it was you meant. It was a good analogy, and I thought it was very fitting when you try to discuss with your family a reverse mortgage.
Well, that's a good place to end our conversation, because I'm very passionate about this. And some people say that I'm a bit of a spendthrift, but we take our kids on vacation every 2 years. We have a reverse mortgage vacation because I just got my reverse mortgage, but I knew I was getting it for quite a while. And we were in Kauai this January. And 4 sons, four wonderful daughter-in-laws that we love, and 5 grandkids. It is the coolest part. I was looking at some of the pictures last night with one of my sons. It's an incredible thing to create those kind of memories. You can't put a price on that. And because we don't have a mortgage, and we never tried to pay off our mortgage when I was 43 years old, when I learned about this, we can have more things like that. Of being able to share my money and my wife's money with our kids now, rather than waiting until we're dead. Where did we ever get the idea that we can only give money to our kids after we're dead? And there's all kinds of people that try to legislate from the grave. They put these trusts together with, you can do this and you can do that, but you can't do this with the money, and so on and so forth. Why don't we just give our wealth away with our wisdom while we're alive? I'm very passionate about that. Why are we so hung up on waiting until we're 90 and the kids are 60 to give our money away? Because we can teach them and help them learn how to build wealth and invest. All 4 of my kids have a house, and all 4 of the kids are investing, and all 4 of the kids are involved with life insurance because they know that those are some of the wealth building tools that are multi-generational. If I wouldn't have some money to give them for seed money, wouldn't be able to do that. And I save them money on vacation so they can go on vacation with us and still invest. And so I think that that's so important, is that we teach our kids and our grandkids what we've learned over the 50, 60, 70 years of our lives. And so we go on vacation, and my son was literally sitting on the beach one time in Cabo, and he said, "Dad, thanks. This is wonderful. I just really appreciate this. This is so special." And we were sharing a cocktail together. And I said, "Well, Isaac, really, you're paying for this." And he almost dropped his drink. And he said, "I thought you were paying for it, Dad. Do we have to help this year?" And I said, "No, Isaac, you're paying for it because you're a real estate analyst. You plug in the numbers. Did you know that what we spent on this trip, this is going to dramatically cut back? If you look at the next 30 years, this really cuts back on how much money you're going to get in inheritance." And he said, "Dad, I'm completely okay with that." So he was okay with getting the money now rather than waiting until he was 60. So I think that that's something. What is life? Dollar bills are nothing more than pictures with dead presidents on, papers with dead presidents on, until we trade it for something of value. And memories with my family is one of the things that's most valuable to me. Thanks for bringing that up, Dan, because that's something I'm pretty darn passionate about.
Thank you very much, Harlan. Appreciate your time. Fabulous. I think we were able to capture on our YouTube channel, but also if you could send me a copy of the seminar, I'll get it out to everybody, and we'll continue to post it to our social media.
Well, thanks, Dan. And Lynn, thank you so much for putting this together, because, Lynn is the quiet, one behind the scenes, but oh my goodness, we are so thankful for everything you do, Lynn, to really make a difference in people's lives.
Lynn is absolutely amazing. So
we're lucky that she's part of our team. That's no question about it. Thanks very much. I'll make sure I get that recording off to you, Dan.
Recording stopped.
Have a wonderful rest of the day.
Thank you so much. Great job.